All right, it is, of course, the Global Business Report. We're getting reactions to the decision from the Monetary Policy Committee to cut by 50 basis points. And we're joined by Felicia Awolope, who is the lead economist at Meristem Research, and Gbolahan, Aina, Managing Director, Cordros Asset Management. Great to have you both. Felicia, did you anticipate this cut? What's your reaction?
Well, to be honest, as at yesterday, it was a decision that was on the table. I was leaning more towards a hold because looking at GDP reports, it looks like the economy is doing well and all that. But of course, the CBN had the legroom to cut. The monetary policy, they had the legroom to cut, and I knew that a cut was, likely. And I just didn't expect a 50 bips cut, to be honest. I was expecting that the posture of the Cardoso administration has been someone who does the needful. So I was thinking if it was going to be implementing a cut, maybe we'll be seeing 100 basis points cuts. But this 50 basis point cuts with the adjustment of other metrics, actually, it's not bad. It's a welcome decision, to be honest.
What was your reaction? What did you see a cut, and did you expect?
Yeah, interestingly, our view in house was the 50 bips cut, and was basically because of all the metrics we've been seeing: disinflation, stable exchange rates, and so we had anticipated a 50 basis point cut. Even though you might say, it's not aggressive, but we thought for the first one it was more of posturing, it was more of signaling that the CBN is comfortable where rates are, and going forward we expect to see further cuts. It might not be subsequent thoughts. I believe that they might watch the metrics before they probably make an decision at the next Monetary Policy Committee meeting.
Yeah. Now, there were some changes. The asymmetric corridor was prior, I think, plus 500 minus 100. That's the band around the NPR. Yeah. Now it's plus 250 minus 250. I need you both to help explain to our viewers. I guess maybe we can define what that is, and then we can talk about the impact. But what do you think they're trying to do there with that by adjusting that?
Okay, just to continue the conversation, the adjustment of the asymmetric corridor around the NPR is also another tool that the Monetary Policy Committee can use to control liquidity and to incentivize or disincentivize banks from borrowing from the CBN or depositing with the CBN. So the upper band, which is the NPR plus 250 bands, plus 250 bips rather, is the rate at which banks lend from the CBN. And so if banks go to the CBN to get loan to be able to manage, their operations and all that, they will be lending it from the CBN at a cost of 250 bips plus what's the current NPR. Now, before it was 500 bips plus 27.5, and that was 32.5%. But now it has been reduced to, 27%, the new NPR, plus 250 bips. Yeah. And that's just around 29.5%. And that's a decision designed to incentivize banks to borrow, because the cost of borrowing from the CBN is cheaper now compared to what it was before this adjustment. And if you look at the lower band, that's the NPR minus 250 bips, that's 27% minus 250, and that brings you to around 25.5%, right? And 24.5%, I think. And that shows that, and before it was NPR minus 100 bips, and that was 27.5 minus 100, 26.5%. So slightly the, attraction to borrow to deposit excess funds with the CBN, because that lower band is the rates that banks get when they deposit excess funds with the CBN. And so I would say the attractiveness to deposit with the CBN is just slightly lower. But given the improvements, the strategic, the adjustment for the upper band, I think this movement or this adjustment narrows the gap between the upper and the lower band, and it's something that is designed to reduce volatility for, lending rates, particularly interbank lending rates.
All right, well, I'll come to you one second. If you're just joining us, of course, we are reacting to the Monetary Policy Committee decision in Nigeria to cut the monetary policy rate by 50 basis points. I'm still adjusting from 27.5 to 25%. We have with us Felicia Awolope, who, of course, is the lead economist at Meristem Research, and Gbolahan, Aina, MD at Cordros Asset Management. So, Gbolahan, what was your reaction to that adjustment in terms of the band around the monetary policy rate?
Yeah, just like you said, it's really more a dovish stance. It was more expensive to borrow from the CBN. SLF was 32.5%. Now it's been reduced to 29.5%. So it's more attractive, if I can use that word, to borrow from the CBN. So it just sort of signals that CBN is moving more towards a dovish stance than a tightening stance that we've seen in the past couple of months.
Okay, I also want to get you both to comment on the cash reserve ratio, the CRR, because in his press conference, Governor Cordros of the Central Bank of Nigeria pointed out that the CBN has observed a build-up in banking system liquidity. So CRR was 50% before for commercial banks and 16% for merchant banks. It's now 45%. And I want to get to this non-TSA in a moment, but yeah, Felicia, let me start with you again. Well, what's your reaction to this? Is there any meaningful impact in reducing CRR to 45 for commercial banks?
Well, feeding off what he has said, this decision, I believe that the decision at this Monetary Policy Committee meeting was more about sending signals to both investors and the public that, okay, so the CBN is, or the Monetary Policy Authority for Nigeria is moving into a dovish stance. And so even if it looks like the cut was a bit minimal, from 50% to 45%, because you would agree with me that, a 45% cash reserve ratio is still quite high, but at least it brings a bit of respite where banks have more capacity, even though it is slightly, just slightly higher. They have the legroom to give out loans and to just do a lot of other activities with at least 5% more of their deposits than they had before this decision was made. And it's something that is just designed to improve liquidity, improve access to credit for maybe the real sector, to maybe ease some of the concerns and constraints that sector has been experiencing for a while now.
Okay. Well, what was your own take on that reduction in CR?
Well, it's minimal, but like I said, it's still a stance that they're trying to. It's more posturing. But in addition to that, they now sort of tinkered with the CRR for non-TSA, and it also shows that even though they are lowering CRR, they still have concern on system liquidity. And that's why they sort of have a 75% cap on non-TSA public sector deposits. Okay, good. So, okay, fine. So let's continue there. So that's Treasury single account, right? What's the intention there? Because 75% is a large. What kind of funds are they targeting with that? Well, so from my findings, state government funds and local government funds, you agree with me that FAC allocation has increased significantly over the past couple of months. Yeah. And they just want to rein in system liquidity. So funds going towards state government has been deposited with the banks. Yeah. So 75% has to be sterilized with the CBN. Okay. Estimate is that might be about 750 billion in terms of size. Okay. Felicia, what's your reaction to that? The TSA. So for non-TSA, excuse me.
Exactly. So for me, one of the reasons or one of the drivers for a cut expectation at some point would be that the Monetary Policy Authority would be reluctant to unravel the significant improvements that we've seen in the economy over time. So there's the need to make sure that we balance it out. Yes, we are moving towards a dovish stance, but we don't want to overwhelm the system with too much liquidity. And then, of course, at some point, looking at statistics, these funds have exceeded the 1 trillion mark at some point last year. And so if we have this much, say, liquidity in the system, and we're increasing CRR for banks, and we're reducing the monetary policy rates, there is that risk that we start to unravel the improvements. Yes, we've made some steps forwards. We do not want to bring us backward. And so the CBN and the Monetary Policy Authority are trying to sort of put a cap on how much liquidity would overwhelm the system, and saying, okay, for funds that are, not going to the Treasury single accounts that the banks have, because for banks, this is a source of cheap funds that they can do so much with, play in the Treasury market, give out loans and all that. And this would bring liquidity into the system and into the economy. So putting this cap is something that would manage liquidity to a certain extent and balance out the expansionary decisions. Yeah.
Gotcha. All right, so guys, what about businesses and individuals? Like, Gbolahan, I'll come back to you. Because when rates are going up, they like to send you letters saying your loan is getting more expensive, and we're, due to economic conditions, so on and so forth. Can businesses and individuals hope for a reduction in the rate? What will this mean? Anything, or what do you think?
So for this, no.
Yeah.
But eventually, 50 bips cut is not so much. And I guess things are still a bit fragile. But I guess as things become more stable, we saw the GDP numbers, we saw GDP quite impressive, 4.38%. So those are sort of metrics that they'll look at in their rate decision going forward. So for this decision, I don't expect to see businesses or the banks reduce borrowing
costs.
At the moment. But eventually, if we continue to see a rate cut, definitely they will reduce.
All right, Felicia, what do you think?
Just like he said, before we came on, I was trying to ask him that, do you think will be so? Because like you mentioned, there's been, we've noticed that over time, there are more significant reactions to rate hikes in terms of repricing than to rate cuts. And now this is a rate cut that is not so significant, and so probably will not be seeing so much more of repricing. But if there are further cuts, like he has mentioned, probably then businesses will start to feel more significant impacts of this. Great.
I want to get both your thoughts on fixed income and money market instruments, so treasury bills, bonds, and the like. Will we see any repricing in that regard at the next set of auctions that take place?
Oh, definitely. So leading to this MPC decision, we already saw yields start to fall. I know for traders, they sort of always try to be ahead of the curve. So what this rate cut has done is that it has shown the direction of yield. And of course, when you know that yields are going to sort of come down, it's a duration matching strategy. You want to go long. So we're going to see yields definitely fall, definitely. Might not see so much in the treasury bill space, but in the bond space, we begin to see further downward spiral in yields. Not aggressive, but gradually.
Okay, Felicia, you're sharing that. What do you think? How do you think things will play?
Of course. I mean, like you said, traders have already priced in this, possibility, and of course, we've started to see yields decline. But one thing I want to add to it would be that yes, yields would decline. Initial reaction to the movement of the adjustment of the monetary policy rates. However, let's bear in mind that there are other factors that drive, rates and yield movements. And by the time liquidity comes up, paper supply on the part of the government, what do they need to borrow? Is the federal government going to be needing more, funds from the domestic borrowers? And those other factors could bring more volatility for yields, short-term volatility. But of course, initial reaction to this, yes, we expect to see yields decline further.
All right. The CBN, of course, as part of this decision, we're talking about the stability in the exchange rates. Also the deceleration in inflation, 5 consecutive months now from April up until August, which is at 20.12. I want you both to, I guess, for anyone who's watching now, wonder, okay, why has inflation decelerated? What have been the triggers? And also exchange rate, why has the exchange rate remained stable? I don't know if you want to take one of each or both, but which one do you want to touch on as far as what we've seen so far with the exchange rate and/or inflation?
Okay, so for inflation is a complex of factors. As at Q3, Q4 last year, we saw poor agricultural output. There was a lot of flooding, and the full subsidy removal kicked in. And for this year, it's a bit different scenario. Base effect is kicking in. The agricultural pattern, there's been stable weather. We've seen stable exchange rate as well. What that does is that for imported component of the inflation, it means that there's sort of a stability. So all those sort of shows that deceleration might continue or will continue. Also, energy price has been stable as well. So all these factors, all these metrics shows that we expect to see sustain this inflation. What we see is that we see inflation rate coming lower than 20% by year end. Okay,
all right. Okay, maybe you can touch on the exchange rate then, as far as or you can also touch on inflation if you want. But yeah, what are the triggers in terms of what we're seeing with the stability?
I mean, like you mentioned, for inflation, minimal yield impact last year because of the flooding, and so we could not enjoy harvest supply as much because the flooding limited yield from harvest. And all those, the impact of the hiking, the total removal of subsidy, they've normalized, and it looks like things are pretty stable. One major component is the stability of the exchange rates, seeing that this economy is import dependent, and so it just minimizes the volatility in price levels for most of these everyday items that we use. And for exchange rates, to be honest, I would say it's been what we expected. We expected to see more stability this year for exchange rates. And you agree with me that we've actually been able to achieve stability for a number of months now. And major driver would be the accretion to the FX reserves. The FX reserves has hit a record high of, I think, around $42 billion now, which gives the CBN more capacity to supply liquidity for exchange rates, and is something that would impact volatility in the market. You know, one thing that also does is that it gives the investors the confidence to bring in money into the economy, seeing that exchange rate is stable. And so if I need to take out my yield, my earnings, my money, I can do that, and this is something that would incentivize. And if you look at capital importation data, you would see that investors are still quite, interested in Nigeria for investment decisions. And for going forward, the Feds have cut rates in their last meeting.
Yep.
And what happens when the Feds cut rates, any advanced economy, is that emerging economies begin to enjoy, diversion of funds because rates tend to be more, attractive in these economies. And so if Nigeria, because yields for Nigeria are still quite high, and 25% compared to 5% in the US, less than 5% at times, this just means that investors would still, be more interested in Nigeria, emerging economies generally. And this helps our foreign reserves. Oil production figures has been, quite stable this year. We've done over 1.5 for crude oil, like 3 months this year. And all those are just improving accretion to the external reserves, which is one thing that is key and important to maintain stability for the exchange rate.
Okay, so based on that, then, I mean, can they cut aggressively? Because I guess if you want to keep attracting FPIs and so on and so forth. So now I want to go into the next meeting now in November with what you've both explained now with exchange rates and inflation and all that. Can they keep cutting? I mean, if you also want to maintain that premium between yourself and what's happening in America, so what do you expect at the next meeting? I mean, depending on how things.
Well, I think it's early days.
Yeah.
And one reason why it was just a 50 bips cut is just to see how things pan out.
Yeah.
So if they were certain about the fact that we are home and dry, they could have cut by 200 bips or 300 bips.
Like Ghana.
Yeah.
Ghana
So they're still sort of waiting to see. It's more like a wait and see approach. So I would say, depending on how inflation sort of moves within the next 1-2 months, also exchange rate as well. Exchange rate has been very stable. Interestingly, a lot of analysts last year were saying that the exchange rate will get to 2,000, 2,500.
Yeah.
So I guess a lot of people are sort of biting their tail now. But I think the CBN has done pretty good thing. And they can't even afford to bring down the rate too aggressively. We saw that, was it last year? Yeah. When rate was almost at 1,000, and we saw a lot of the FPIs fleeing. So that attractiveness must still be there. So it's not going to be aggressive. I think it's going to be a steady thing. But in terms of whether they're going to cut or not next MPC meeting, I think as things evolve, we'll be able to say.
Yeah. Felicia, what do you think?
Yeah, I mean, of course, like you mentioned, the CBN is testing the water, starting with 50 bips to see how it pans out. But you'd agree with me that a lot of the metrics that the CBN, the Monetary Policy Authority, is looking at currently looks quite stable. Accretion to FX, one major confidence for them, saying, yes, we have the ability to defend the Naira with over 8 months of import cover and all that. And inflation is expected to continue decelerating because we're in the harvest season, increased supply of food items, global commodity food prices are a bit stable. You understand, looks like supply chain disruptions have normalized, and it just looks like, yes, inflation would continue to decelerate, economic growth strong, and exchange rate stable, and it just means that except there's, events or updates come up that negate this improvement, it just sets the stage for a more pronounced cut, maybe not 200 bips, but maybe more than 50 bips that we saw. And except, things come up and maybe some of the concerns that have been there that had made the CBN hold for the most part of this year should materialize, then maybe we might not see further cuts. But for now, I think we should just, expect a further cut in rates at the next meeting. All right, I want to get your quick, Gbolahan, I think you touched on GDP earlier when you were talking about a few other things. But just your quick thoughts on both of you on the 4.23% second quarter numbers that we got for economic growth.
Well, pretty decent, pretty attractive. And of course, everybody's happy about the data. It was majorly supported by oil production, like you said, 1.6 million barrels, which is quite impressive. We also saw some sectors do very well, service, industry. There was sort of an increase in agriculture as well. So from the look of things, also the base effect as well, we think that this might be sort of sustained going forward.
All right, Felicia, what do you think of the GDP figures?
Quite interesting numbers, if you'd ask me, because these were the numbers that we expected post-rebasing, for Q1. It looks like there was a lag before we are finally seeing, what we expected. And like you mentioned, for the first time, the crude and petroleum components is contributing the highest to the GDP growth, total GDP growth. That's crude and natural gas components is contributing around 16% to that growth. And this just speaks to the improvements that we've seen in oil production. And then we're seeing improvements in the telecom sector, the agri sector is, rebounding. And it just means that some of the actions, some of the initiatives that both the fiscal policy and the monetary policy have implemented are beginning to give benefits. And of course, we expect that this will continue in the near term. We expect oil production figures to, still continue to improve, maybe minimally, but for the midterm, maybe we would see more pronounced improvement for oil production. And for the other sectors, there are a lot of fiscal policies that are going around that could yield gains for some sectors. For the agricultural sector, there's a lot of stuff going there. You would agree with me that the federal government is doing a lot to improve food production. And although this may not be near-term, plans, we'll begin to see impacts maybe in the mid to long term. And so the expectation is that growth would remain robust for GDP, or for the economy rather, in the near to mid term.
You guys, thank you so much for taking the time to react to the MPC decision and also to forecast what to expect in the future. Felicia Awolope, lead economist at Meristem Research, and Gbolahan, and managing director, Cordros Asset Management. Thank you both for your time. Really appreciate it.
Thank you for having me.